All right, so now we're going to move away from assets and we're really going to start thinking about liabilities. So we're going to go onto the liability side or the other side of the balance sheet and away from assets. So we're going to be looking at today just liabilities, both short term and long term liabilities. And I want to break the liabilities down into two specific groups: contractual liabilities and contingent liabilities. So I want to kind of break that down into those two specific groups: contractual liabilities and contingent liabilities. Contractual liabilities cover a lot of ground, a tremendous amount of what we do as an organization. Purchasing goods. There is a contractual liability when I sign a purchase order and someone's going to deliver me something, and in exchange, I have to pay them back. That is a contractual liability. Paying employees. We have a contractual liability. We have these employees. They've agreed to perform X hours of work, and in exchange, we've decided to pay them cash. And any other types of contracts we end up signing. For example, if we enter into a loan or we issue debt. And I look at those things as two separate, right? The loan, I'm going to go to the bank and get the loan. The debt, I'm going to sell to investors. Loan and debt interchangeable, they're both debts. But I just want to make this, I want to make a subtle difference whenever I talk about a loan. I'm assuming that you've gotten that from a bank. When I talk about debt, I'm assuming that you have floated some kind of instrument that ultimately you're going to be obligated to pay back these investors, whether with interest or principal or what have you, right? So these are all contractual liabilities. And so anytime you enter into a contract where you have an obligation to pay somebody, that becomes a contractual liability. And these liabilities need to get recognized when they are incurred. Okay? And that's very similar to when we talked about expenses. We're going to recognize expenses when it's incurred. Well, we're going to recognize these liabilities at the same time, because generally when I pay an employee, I'm incurring an expense. I'm also have the other side of that, which is the contractual liability that goes with it. Now, contingent liability, there can be a number of different things that could be contingent. The contingency could be, for example, contingent liabilities for tax payments. If I make money, then I have to pay taxes. I don't have a contractual liability, but I have a contingent liability depending on what activities I engage. If I sell a good, I collect the sales taxes. I have to remit those sales taxes back to the state. That becomes a contingent liability. It's contingent upon me making the sale. Right? I don't have a contract with the state. I have an obligation to the state given the activities that I perform in the state. If I make money, I have a contingent liability to the federal government and to a state government and potentially to a city government. But that's contingent upon me doing something that is going to force a tax payment. Other contingent liabilities could be fees, fines for inappropriate or illegal behavior, right? It's contingent upon a number of different things. One, it occurring. I've done something incorrect that has generated the fine, and there's some degree of discovery, right? So there has to be a likelihood that this is going to happen, right? So that could be a contingent liability. Lawsuits are contingent liabilities. Might get sued, but some other things might have to happen in order for that contingent liability to actually be recognized. And so when we think about contingent liabilities, this is based on incurred contractual liabilities. Contingent liabilities, there's a few things that we have to look at. We have to look at two things: likelihood, and we have to look at measurability. Those are two important issues, because if I can't measure what it is, I may not be able to recognize a liability. If the likelihood is not very high, then I may not have to recognize the liability. So when we think about contingent liabilities and likelihood and measurability, there's a lot of judgment around that. There's less judgment here, right? When it's incurred, I have that liability. But down here, I have a lot of judgment involved with that. So let's talk a little bit about these contingent liabilities. So there's three classifications, if you will, of the likelihood. The first one we'll talk about, which is nice and easy. If we determine that the likelihood is remote, right? So, I'm going to blend likelihood and measurability together. So in this case, it's remote. We may know what the number is, but it's not likely. The accounting answer for this, what do we do? What is the accounting? And over here, we're dealing with the likelihood and measurement, right? The accounting here is ignore maybe some really broad disclosure, so ignore, or some innocuous disclosure. Like from time to time, we are involved in different lawsuits, and we don't believe that any of these lawsuits will be successful. That would be a disclosure that really doesn't talk to what you've been sued for. So that's, if you determine your likelihood, you don't really need to worry about measurement. If you make that judgment, the accounting is you can just ignore it or do some level of disclosure. If you believe that the likelihood is more likely than not, and if you wanted to try to attach a percentage to this, I'd say 50% plus. Not all the way to 100, but 50% plus, around that. This is also going to require some disclosure. With more specifics. And that might include how much you're being sued for, what the outcome could be, and most of the time we'll say we believe that more likely than not we'll be successful. Because it's a 50-50, right? The last one is if it's deemed to be probable. Right? And this is 75% plus, right? So there's a good chance that the plaintiff is going to be successful. In those instances where it's probable, we then also have to see, is it also measurable? can we come up with an estimate? Right? Is there a point estimate? Or is there a range of estimates? Right? So if it is probable, then it definitely needs disclosure. And it will also need some accrual, some recognition of a liability. And the related expense, right? We're going to increase the liability, and therefore we're going to decrease our overall equity, our overall worth through an expense. If it's a point estimate, we're going to recognize the point estimate. All right, we're going to recognize the point. If we can get to this is how much it is, we're going to recognize that point estimate. If we don't have a compelling number within this range, we're going to recognize the lower end of the range. Right? So there's going to be some recognition of a liability, and if there is a point estimate, a good point estimate that is probable, then we're going to recognize that point estimate. If we don't know a particular point, but we have a range of potential outcomes that could be as little as X and as much as Y, then the literature tells us we've got to recognize the lower end of that range. So this is how you deal with contingent liabilities. So we've got contractual liabilities and we've got contingent liabilities.